Hi there, welcome to Kneppy Invest. Only about 8 more financial year 23 videos to do, including the focus of today's video, which is Readytech, recent listing on the ASX. And when I mean recent listing, I'm talking about within the last 5 years. I have been a shareholder of this company in the past. However, I did sell out, and I think I sold out around the time there was a takeover bid for the company in late 2022, and I just haven't bought back in. But there are a few things to like about this company, maybe a few things not to like, not necessarily red flags, but mainly just around their profitability. So let's have a look at Readytech. And the first thing I'm going to do is talk about what this company actually does before we have a look at their financial year numbers for 23. Also have a look at their half year numbers for financial year 24, because we are past that point right now. Okay, so overnight, I was informed by FinChat, which is this financial services platform that I have subscribed to a few weeks ago over Guru Focus. They told me that their AI platform had been improved. And to be honest with you, I had no idea they had an AI platform. So I decided just to play with it this morning, and I put into the AI chat, provide an overview of Readytech company listed on ASX. And all this information it gave me was actually pretty good. Now, a little bit light on details in exactly what Readytech does. It just says here that they're a SaaS technology solutions company in various sectors, including education, workforce, and government and justice. So it doesn't really tell me exactly what they do. But a lot of our stuff here was quite impressive. In fact, their conclusion I actually agrees with. The valuation metrics suggest that the stock is somewhat highly valued, and probably my one gripe on this company is just the earnings. I'd like to see a little bit more profitability, but could be justified by its growth trajectory and solid market position. And I'd probably have to agree with that. So how would I describe Readytech? Now, Readytech is a SaaS company with payroll and workforce, human resources, recruitment and onboarding, and training solutions. And the company has three main segments or divisions: education and work pathways, workforce solutions, and government and justice. So for those companies who like, or those investors who like SaaS companies, maybe Readytech is one of those companies for you. So let's get into the financial year 23 numbers, and these numbers are becoming a little bit old. So we are looking backwards when we should be looking forwards. And that is the one problem with looking at financial numbers. You are looking backwards, you're not looking forwards. And you might say profit down 43% to 5 million. I don't know about this company. Now, that's probably one of the last things I look at in these type of companies is the profitability. And that's probably the only thing I'll be looking for in terms of Readytech. I want to see the profitability rising through time, and I'll talk about that again in a few slides. But revenue up 32%. 203.3 million. Now, Readytech has been acquisitive over the past few years, so you should expect the revenue to grow. But the one thing I would like to look at is revenue per share growth, and revenue per share growth is climbing for this company. Gross margin at 34.4%. I like that to be a little bit higher. Now, it was hard to find gross margins for this company, so I had to dig a little bit deeper, and that's the number I gave. So it could be a little bit out there, but they didn't provide that information in the financial statements. Operating cash flow, 27.8 million. Free cash flow, 26.4 million. So whenever you see operating cash flow and free cash flow significantly greater than profit, there is something going on there. But you can see that sort of information, why there's a difference, just by looking at the notes, in particular, the reconciliation between the cash flow and the profit. And the reason there is a big difference is all because of depreciation and amortization. Net debt, 26 million. Now, that's not a concern for this company. I don't like companies with too much debt, but a company that has net debt of 26 million, that has a market cap of 400 million, that is growing, that is profitable, and is generating cash flow in the business, I think that's definitely manageable in the short to medium term. Now, a few other factors or facts in regards to Readytech. Shares on issue 119 million. Markup is 400 million. That's at a share price of $3.36. Last time I looked, our share price was $3.40. Equity, 128 million. Now, you also notice return on equity and return on invested capital a little bit low, and that's because of profit. And return on equity and return on invested capital is something I look at, but I'm ready to go past those low numbers for this company because I think profit of 5 million is a little bit low, and I think the profitability for this company will increase significantly over the next few years. So, sort of profit I would be looking based off market, based off equity, would be at least $15 million a year. So, triple to what the profitability of this company is right now. And of course, dividend yield is not applicable because this is not a dividend paying company just yet. And to be honest with you, they should not be looking at paying dividends. They want to be growing their company. So again, dividends suppress growth. So those companies who want to grow and grow significantly should, at the very most, just have a token dividend, not a large dividend at all. So my only gripe about Readytech is their profitability, and this is the half-yearly profitability going back to 2018. We don't see much of a growth here, but the company has been profitable on a half-year basis since 2019, but you can see there's not any trajectory at all. In fact, their best half year was back in 2021 when they had $5.8 million in profit, and since then it's been quite lumpy. In fact, only $2.1 million of profit in the most recent half year, which I'll touch upon again later in the video. So this is my one gripe, my one red flag in regards to Readytech. It's just a profitability, but it's also the last thing I always look at. I always start off with revenue growth, operating cash flow, free cash flow, and then I go and look at margins, and then I go to profit. And here is a table of things I do initially look at. We're talking about revenue through time, operating cash flow through time. I've also included shares outstanding. Now, this is from FinChat. And FinChat does something interesting. They also give you the CAGR of everything you looked at, if you want it. And we'll first talk about revenue. Now, I like to look at revenue per share, and that's why I've included shares outstanding. But when I do see revenue increasing through time, also want to know how shares outstanding have been increasing. So revenue has been increasing at 30.09% per year over the past 7 years, while shares outstanding have been increasing by 21.6% per year. So revenue per shares have been increasing over the past 7 years, and cash flow from operations increasing at 67.6% per year. So even though profitability is sort of stuck, not really increasing through time, revenue is increasing, operating cash flow has been increasing as well. Now let's have a look at Readytech's half-year results, and this is from the company's first half financial year 24 presentation. So some things to like, some slight red flags in here, and I'll talk about profit and why I think this company is a little more profitable than what they're letting on. And it all comes back to conservative accounting practices in regards to amortization of acquired intangibles. And I'm not the biggest fan of that because it doesn't give a true representation of how profitable a company is. So first thing I always look at is revenue. So revenue up 17.1%. Now, one slight red flag is that expenses grew at a greater rate than revenue, 15.5% compared to 14.2%. I'd like to see the reverse. I like to see revenue growing at a greater rate than expenses. That's what I want to see. Underlying EBITDA up to 17.4 million, up 10.6%. Underlying EBITDA margin down slightly by 0.8%. That's a slight red flag as well. But the main things here, revenue is still growing. Now, the reason why underlying EBITDA, cash flow, operating cash flow, free cash flow of this company is significantly greater than the NPAT and the profit after tax and amortization is because of depreciation and amortization, $5.3 million in this half year, and amortization of acquired intangibles, which was $3.8 million. Now, that's really conservative accounting. And I really discovered this about 10 years ago when some internet providers acquired some other internet providers, and they were amortizing the acquired subscribers. And it really didn't give a true representation of how profitable these companies were. And I really like what Readytech have done here. So underlying EBITDA, which includes amortization of acquired intangibles, $4.1 million. Then they've excluded that amortization of acquired intangibles post-tax, which was $2.7 million, which means the underlying NPATA, which doesn't include that amortization of acquired intangibles, was $6.8 million, which is better representation of how profitable this company is on a half-year basis. Last year, though, actually, the underlying NPATA was $7 million. So there was a slight decrease in underlying NPATA in this half year. So that's another slight red flag. For all companies, no matter how big they are, I'm always going to have a glance at debt. And for Readytech, their debt is completely manageable, $50 million of debt, but they also have $21.9 million of cash and cash equivalents, which means their adjusted net debt is $29.4 million, slightly up from last year, but no concerns, to be honest with you. And net debt to EBITDA is only at 0.7. Now, EBITDA and cash flow a lot of times will be fairly similar, and sometimes the differences between EBITDA and cash flow from operation activities is just changes in working capital. In fact, they've gone through this in the bottom half of this particular slide. So EBITDA 16.5 million, changes in working capital at 1.3 million. So cash flow from operating activities at $18.7 million. So this company is bringing a lot of cash in their operations, and that's a really good thing moving forward for the company. Another thing I like to look at for all companies is just a breakdown of revenue, EBITDA, profit, whatever, by segments or divisions. And they have provided this information in the presentation. A lot of times the company will provide that information in the notes section of the financial statement. So they've divided the company into three distinct segments: education and work pathways, workforce solutions, and government and justice. The other thing I like to, and another reason why I like to do this is just to see which segment is more efficient, more profitable, has higher margins, that sort of thing. So when you look at the revenue breakdown, nice increase in all three segments. So up 18.3% in government and justice. And I'm pretty sure government justice is an acquisition they made a few years ago. So nice increase in revenue for all three segments. Then look at EBITDA, nice increase in EBITDA, particularly in government and justice, up 16.7%. But EBITDA margin is one thing I like to look at. Which segment is the most profitable or the most efficient? And that's education and work pathways, EBITDA margin about 43.2%. But the highest growing segment is probably the least efficient. And this is probably a reason why the overall overall EBITDA margin or margins of the business are dropping, because government justice with EBITDA margins of only 27% is the quickest growing segment this company has. Now onto the chart, and this is the weekly chart for the company from when they listed on the ASX back in the middle of 2019. So about April 2019. So this company's been on the ASX for 5 years. I thought this company was a newly listed company, but I'm not sure if you can say that for a company that has been on the exchange for 5 years. Anyway, a weekly chart, which is not that bad. If you bought in at the IPO at about $1.70 or so, you're okay, happy. Share price has doubled since that time, and no significant downtrend in the share price at all during this period. There's been times, short periods of time, when the share price has fallen during the COVID-19 financial panic. We saw the share price fall back in late 2022 when the takeover bid for the company fell through, and since then the share price has been just going up quite slowly. So if you're in this company for the long term, I don't think you'd be dissatisfied with the share price performance so far. I like to see the share price get back up to its all-time high, which is at about $4.30, and right now at $3.40. It's still a little bit off that. So many things to like about this company. I think the valuation is about right. I'd like to see the profit increasing a little bit more, but nice cash flow, nice EBITDA, nice revenue growth. So many things to like about Readytech. And yeah, I think that's all I've got to say about this company. So about 8 more videos to go in this series. In fact, I think it might be a little bit more than that. I've got little pieces of paper with a list of companies on it, and I think there might be like 10 to go. Including people I see at the top of that list. So anyway, the next 5 videos in this series, and I hope I complete this series by August. So that's still 4 months off. So I should easily complete this series by August. The next 5 companies I'll be looking at will include AGL, Clinuvel, Beam Communications, AVA Risk, and Swoop. So funny enough, I own 3 of these companies and trading AGL. So the only company I don't own out of these 5 is Beam Communications. So that's all I have for this video looking at Readytech's financial year 23 results and the first half of financial year 24. What do you think about this company? I actually quite like Readytech. I think it's a nice company. If the market cap of this company was, say, $200 million, I probably would be a shareholder of the company right now, particularly for the medium to longer term. At $400 million, I'm like, I could see maybe some value in there. I'd like to see the profit increasing, but at $400 million, I just think it's probably fairly valued at that price. So what do you think? Are you a shareholder of this company? And what do you think of this company moving forward? So I'd love to hear your opinion. Leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.